deep to the world of crypto. You're listening to Vorpen AI.
Ever imagine turning a profit from crypto, even when the market's, well, in free fall?
Right, like who wouldn't want that?
Exactly. So today's deep dive explores just that, stablecoin arbitrage.
We'll try to break down if it really lives up to the hype.
We're diving into a paper by Tony James, CEO of Vorpen AI, to see how this strategy works.
It's a fascinating area, really, where you have the stability of traditional finance, but it meets, the agility of the crypto world.
So let's break it down. First things first, what exactly are stablecoins? And why are they different from, say, the Bitcoins and Ethereums of the crypto world?
Good question. Think of stablecoins like digital dollars, essentially, cryptocurrencies, but the key is they're pegged to the value of a stable asset, usually the US dollar. So instead of, that roller coaster ride of Bitcoin, stablecoins like Tether, that's USDT or USD coin or USDC, aim for price stability.
Makes sense.
Yeah, and that makes them ideal for transferring value quickly without worrying about sudden price swings.
Okay, so less about getting rich quick, more about having reliable digital cash at hand.
Exactly. And that reliability is where this whole arbitrage thing comes in. Imagine you're at a market, someone's selling apples for $1 in one stall and $2 in another. What would you do?
Buy all the cheaper ones.
Well, yeah. You'd buy low and sell high for an instant profit, right?
That's arbitrage in a nutshell. Now, just replace apples with cryptocurrency and stalls with those digital exchanges.
So you're capitalizing on those tiny price differences across exchanges.
Yeah.
But where do stablecoins fit into all of this?
They're the key to minimizing risk. See, crypto prices, notoriously volatile, right?
Uh-huh.
But because stablecoins are, by design, designed to hold their value, they act as kind of like a safe haven amidst all that storm.
That's huge. So even if the market takes a dive, you're not left holding a bag of, worthless digital tokens. Your profits are, in a sense, safe because you're using stablecoins.
Precisely. It's like having a financial anchor while you're navigating the choppy waters of crypto trading.
I like that.
And it's not just about mitigating risk, it's also about speed. Stablecoins often utilize blockchain networks that are, they're designed for faster, cheaper transactions, especially compared to like Bitcoin or Ethereum.
So you can jump on those arbitrage opportunities before they disappear, which is essential in a fast-moving market like crypto.
Absolutely. And this speed becomes even more critical when we're talking about triangular arbitrage. So imagine spotting a price discrepancy, not just between two assets, but between, say, Bitcoin, Ethereum, and Tether, all on the same exchange. You could use Tether as like your stable base.
Okay.
Buy Bitcoin, use that Bitcoin to buy Ethereum, and then immediately convert it all back to Tether, locking in a profit from all those price differences.
Okay, using the stablecoin like a stepping stone to hop between assets. Got it. The paper also mentions something about lower fees with stablecoins. Does that have to do with these different blockchain networks?
You got it. Think of it like choosing a toll road over a congested highway. Some blockchains, like Ethereum, they can get really congested with transactions, leading to higher gas fees. But stablecoins often operate on faster, less congested networks, like Binance Smart Chain is a great example, where transactions can cost, a fraction of a penny. And these savings, they add up, especially in arbitrage, where every fraction of a percent counts.
So it's like getting a discount on your trading fees just by using the right stablecoin on the right network. Smart. But hold on, before we get too deep into the weeds here, let's talk about the elephant, or should I say the stablecoin in the room, Tether. It seems to be the most popular one for arbitrage.
It is. It's the most widely traded stablecoin, which usually means it has really high liquidity. And this is crucial for arbitrageurs because it allows them to buy and sell large amounts without significantly impacting the price.
But isn't there like some controversy around Tether? Like, is it really as stable as it claims to be?
That's the billion-dollar question, literally. So Tether claims each USDT is backed 1.1 by actual US dollar reserves. But there's been a lot of debate about the transparency and validity of those reserves.
So better trust me, bro, going on.
Yeah, to some extent. I mean, they've released attestations from accounting firms, but the skepticism remains. And this isn't to say avoid Tether entirely, but it's essential to really understand, the underlying mechanisms and potential risks of my stablecoin before going all in. Diversifying across multiple stablecoins can be a good way to spread the risk.
Don't put all your stablecoins in one basket. Got it.
Yeah.
This is already making me think differently about risk in crypto. But even with those risks, the potential of stablecoin arbitrage it's pretty appealing. Almost sounds too good to be true.
And that's where we need to inject a dose of caution. Nearly risk-free doesn't mean completely risk-free. There are always things that can go wrong, even with stablecoins. One is what's called smart contract risk.
Right, you mentioned those earlier, those algorithms that help stablecoins maintain their peg.
Exactly. So those algorithms are run by smart contracts. Basically, think of it as lines of code living on the blockchain. And just like any code, those smart contracts can have vulnerabilities. If a hacker exploits a bug in a stablecoin smart contract, that could lead to, well, some really unexpected price fluctuations.
So much for stable, huh?
Yeah, precisely. Then there's the ever-present risk of regulatory changes. I mean, the crypto landscape is constantly evolving, right? And governments, they're still figuring out how to regulate stablecoins, new laws, new restrictions. They could significantly impact arbitrage strategies.
It's like playing a game where the rules can just change, like at any moment. What else should our listener be aware of?
Well, while stablecoins are designed to kind of withstand the volatility of individual assets like a Bitcoin, they don't exist in a vacuum. If the entire crypto market experiences a major downturn, even stablecoins could be affected. We could see temporary price fluctuations or a rush for liquidity that could make trading really difficult.
So keep an eye on the bigger picture, not just individual stablecoins.
Exactly. But, despite these risks, the use of stablecoins in arbitrage, it points to a larger trend. The crypto market, it's maturing. We're seeing more institutional adoption, increasing regulatory clarity in certain jurisdictions, and the development of these really sophisticated tools like stablecoins, like these arbitrage platforms. And that's attracting more sophisticated investors.
It's becoming less about like blindly chasing the next meme coin and more about strategic trading, long-term investment.
Absolutely. And stablecoins are like a key driver of this whole evolution. Now, you mentioned Vorpen AI earlier. Their platform, they claim to automate this entire stablecoin arbitrage process, right?
Yeah, it promises to do all the heavy lifting, identifying arbitrage opportunities across multiple exchanges, executing trades automatically, even while you sleep. Sounds amazing, but almost too good to be true, especially in the crypto world.
It's important to be cautious always with any platform that claims to generate, guaranteed profits in the crypto market. While automation can remove some emotional biases from trading, it doesn't eliminate risk entirely.
So what are the potential downsides of relying on a platform like Vorpen AI for stablecoin arbitrage?
Well, for starters, you're placing a lot of trust in their technology, right? How reliable are their algorithms? How secure is their platform from, hacks or exploits? These are critical questions any investor should ask before handing over control of, their assets.
It's like the old saying goes, if something seems too good to be true, it probably is. What other red flags should our listeners watch out for? It's like the old saying goes, if something seems too good to be true, it probably is. What other red flags should our listeners watch out for?
Yeah, I mean, fees are a big one. Does Vorpen AI take a cut of your profits? Is there a subscription fee to use their platform?
Right.
Those costs can eat into your returns, especially if you're not, generating significant profits. It's crucial to really understand the fee structure before you commit.
Transparency is key. What about those black swan events, those unpredictable market crashes that nobody sees coming? Can a platform like Vorpen AI really protect you from those?
That's the million-dollar question. Even the most, sophisticated algorithms can't predict the future, right?
Right.
A sudden market crash, a major regulatory change, those things could still create losses, even with automated trading. Remember, no investment strategy is foolproof.
So stablecoin arbitrage, it isn't a guaranteed path to riches, but it's a fascinating strategy with potential if you approach it with caution. Where does that leave our listener who's just, dipping their toes into these crypto waters? Is this something they should consider?
I think it depends, as always, on their risk tolerance and their understanding of, the technology. Stablecoin arbitrage, it isn't for the faint of heart, but it really highlights how the crypto market is maturing. And even if you're not ready to dive into arbitrage, just understanding stablecoins and their role in this evolving landscape, it's valuable.
It's like learning A new language. It opens up a whole new way of seeing things,
Mhm.
even if you never become fluent.
Exactly. And who knows, as you become more comfortable with crypto, you might explore stablecoin arbitrage further. But even if you don't, this deep dive hopefully has given you a foundation to build on.
Absolutely. So for those feeling inspired to explore further, what would you recommend they look into next?
That's a good question. Decentralized finance or a DeFi is a great place to kind of continue the journey. This is where a lot of the innovation with stablecoins is happening, particularly in, like lending and borrowing and those yield farming strategies we touched on earlier.
Sounds like we might need to do a whole other deep dive on that topic.
Definitely a story for another time. The key takeaway here is that the world of cryptocurrency, it's constantly evolving, and stablecoins are at the forefront of that evolution.
So stay curious, do your research, and maybe have a fire extinguisher handy just in case the crypto market, decides to spontaneously combust.
Sound advice.
Yeah.
And, never invest more than you can afford to lose. That's rule number one in any market, but especially in the world of crypto.
Couldn't agree more. Well, on that note of cautious optimism, it seems we've reached the end of our stablecoin arbitrage deep dive. Hopefully you, our intrepid listener, are emerging from this whirlwind of information, feeling not just informed, maybe even a little inspired.
Inspired to learn more, explore further, and to approach this exciting, ever-changing world of cryptocurrency with a healthy balance of curiosity and caution.
And maybe a little bit of that what if, wonder that keeps us all coming back for more. Until next time, happy trading, and may your portfolios be forever green.